Hey everyone. Starbucks is one dividend stock down 18% that I think you might regret not buying on this dip. Of course, Starbucks stock was down way more. It was down 45% at one point and then soared higher. But now, after the company released earnings just a couple of days ago, the stock price came down another 9%. So it's giving you another opportunity here to buy this excellent dividend stock on the dip. In this video, I'm going to briefly explain why I think you might regret not buying this dividend stock on the dip. Starting with Starbucks dividend yield, right? It offers a healthy 1.5% dividend yield. Management has expressed its interest to grow this dividend over time. Given the company's excellent job boosting revenue and profits, you can reasonably expect Starbucks to make good on that promise to grow dividends over time. The other thing to love about Starbucks is the annual revenue growth. Look at the revenue from 2014 to 2022, 2023 here. From less than 18 billion, let's say 15 billion in revenue, Starbucks has more than doubled up to 32.25 billion. Even after the big decline in the aftermath of the pandemic, the company has recovered to 32.25 billion. And this is despite the company not being completely recovered to where it was before the outbreak, right? The company has a significant presence in China, and the economy in China only started reopening a couple of months ago. So they're still catching a tailwind from that. I expect revenue to continue higher. In fact, management has said revenue is going to grow by double digits this year, and earnings per share are going to grow by almost 20% this year. The other thing to note about Starbucks is a solid operating profit margin. Now, this has fluctuated recently due to the pandemic and has come down even more recently due to rising wages. But there is a good trend, a tailwind here in that Starbucks is investing in making more stores in its international segment. Why is that good for investors? Well, Starbucks stores in its international segment are more than 500 basis points more profitable than the stores in North America. You can understand why, right? Rent is lower internationally and wages are lower internationally. So Starbucks in its most recent quarter, it opened roughly 450 new stores. 350 of them were international, only 100 in North America. That's been the trend in recent years. Starbucks opening more locations internationally, making a greater portion of its stores international outside of North America, which is boosting the profit margin prospects over time. Now, this is down because of rising wages recently and the fact that the Chinese economy only recently started reopening. That's a big part of its business. Once that part of its business gets back to full strength, you can expect Starbucks profit margins to go closer to 18% is what management has forecasted over the next 2 to 4 years. Similar to its operating profit margin is Starbucks cash flow from operations. You could see longer term over the last decade, cash flow from operations to sales hovers around 15%. It's fluctuated up and down, but it hovers around 15%, which is solid for a company that is essentially selling coffee, right? Selling coffee and growing new locations, adding same store sales growth, doing a really good job expanding its presence. So investors can be happy with this cash flow from operations to sales ratio, the sustainability of that ratio over time as well. Finally, the last reason why you might regret not buying this dividend stock on the dip here is because of the valuation. The recent dip here has brought Starbucks forward price to earnings ratio from 28 down to 25.42 just in the last couple of days here. So you're getting a roughly 10% discount on Starbucks stock. Meanwhile, as like I mentioned, management expects its earnings to grow almost 20% this year. And in my opinion, that's a conservative estimate. If you watch my video about Starbucks first quarter earnings results, you will have noticed that earnings jumped by 36% year over year, but management is only forecasting a roughly 20% growth for the entire year. So I think they're being a little conservative in that estimate there. Good news for you, you can scoop up Starbucks stock with conservative estimates at a reasonable valuation. And for all those reasons, I think you might regret missing out on Starbucks stock here. It's one of my top 23 stocks to buy in 2023. I'll link you to that video at the end of this one I made in January. All right, that's all I've got for this video. Thank you so much for watching. If you liked it, please subscribe. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.